is a stock trading around $400, boasting a PE ratio over 370, and facing like massive insider selling at a total value trap? Or, uh, or is it somehow still the most undervalued tech play of the decade?
I mean, that is literally the $800 billion question dividing Wall Street right now. You look at the exact same ticker, and depending on your underlying assumptions, you're either watching a legacy automotive empire crumble under its own weight or, the genesis of the world's first true robotics monopoly.
Right, there's just zero middle ground left.
Exactly.
And the clock is seriously ticking on this debate, because today is Monday, April 20th, 2026.
Hmm.
We're exactly 2 days away from a high-stakes Q1 earnings report hitting on Wednesday, April 22, and that report could rip this stock in either direction.
Oh, without a doubt. I mean, Tesla, ticker symbol TSLA, is currently sitting at $400.62, up 3.01% intraday. And frankly, the market just feels like it's holding its breath.
Yeah, it really does.
And for good reason, right? The tension between the surface-level price action we're seeing today and the actual underlying financial reality of the company, it's stretched to an absolute breaking point.
Which is exactly our mission for this deep dive. We are taking a giant stack of recent market data, technical signals, and the company's own financial reports to figure out what happens when chaotic forces pull a stock in completely opposite directions.
It's a tug of war.
Yeah, a massive one. But real quick, a quick housekeeping note. If you are watching this deep dive on YouTube, take a second right now to like the video, subscribe to our channel, and definitely leave your feedback in the comments. We want to know where you stand on this polarizing debate.
We read all of them.
We do. Also, crucial reminder here, everything we cover today is purely an educational analysis of the source material. We're looking at data, we're looking at history, market signals. This does not constitute financial advice.
Right. We are here to decode the mechanisms driving the market, not to manage your portfolio.
Well said. Okay, let's unpack this. Let's start with the immediate reality of the stock price, because if you just glance at the chart right now, it looks incredibly bullish. We're seeing a breakout from a multi-month descending channel.
Yeah, the volume today is insane.
Right, over 90.64 million shares moving compared to the daily average of 63.2 million. So institutional money is clearly taking heavy positions before Wednesday's earnings. I mean, to me, it looks like a tightly coiled spring. Is that spring finally snapping upward?
Well, they are piling in, and it's creating this massive intraday swing. Today alone, we've seen the stock bounce between a low of $391.65 and a high of $409.28. And if you zoom out to the 52-week range, I mean, it has been an incredibly violent ride.
Yeah, from what, $222 to almost $500.
Exactly. $222.79 all the way up to $498.83.
So the technical resistance on this chart really is like a pressure cooker. You have buyers turning up the heat, pushing the price against these historical ceilings.
And the indicators are wild right now. For example, the 14-day relative strength index, or RSI, it's currently sitting at 68.83.
Which is right on the edge. Yeah, for anyone tracking momentum, an RSI approaching 70 usually screams that a stock is overbought and, due for a severe pullback. But at 68, the algorithms are technically still treating it as a buy signal.
Right, and you have to add the MACD to that, the moving average convergence divergence. That's currently sitting at a positive 10.28.
Which, let's translate that for a second, because MACD sounds like a complicated math problem for people who don't day trade.
Fair enough.
It's basically a trend-following momentum indicator. It shows the relationship between two moving averages of a stock's price. When it's positive and expanding like this, it tells traders that the short-term momentum is accelerating much faster than the long-term trend.
It's the market equivalent of stepping hard on the gas pedal.
Exactly.
And that acceleration is pushing the current $400 price above two critical historical markers. You've got the 50-day moving average, which is at $368.41, and the 200-day moving average sitting at $376.70.
So the bots are just eating this up.
Oh, absolutely. Algorithmic trading systems look at that specific setup, the current price sitting above both the short and long-term averages, and they blindly execute buy orders because the trend just looks undeniably positive.
See, I'm not buying the blue sky narrative, though. There is a massive, glaring contradiction hidden in the middle of all those green signals. The 100-day moving average is deeply bearish. It's sitting at a negative 13.21%.
What's fascinating here is how those moving averages tell different stories. Think of them like a car's speedometers tracking different phases of a road trip. The 50-day is your current highway speed. It's fast, highly reactive to the immediate traffic.
Right.
The 200-day is your average speed for the entire cross-country journey.
But that 100-day is the intermediate trend. It's telling us that even though we're suddenly speeding up today with this 3% jump, the overall trip has actually been slowing down for the last 3 months.
Yeah, that negative 100-day average is acting like a heavy iron lid on your pressure cooker analogy. It strongly suggests this breakout we're seeing today isn't a true macro trend reversal.
It's a fake out, basically. It's likely just a short-term consolidation breakout. The stock is rallying temporarily within a broader, entrenched downward trend.
Meaning it is going to hit a ceiling very soon. We
Yeah.
have immediate support down at $385.71. If Wednesday's earnings disappoint, and the price falls below that floor, the technicals show a terrifying air pocket underneath.
It could drop fast.
Fast, the stock could unwind rapidly down to $338.27. On the upside, the resistance is capped at today's high of $409.28, with a one-year target wall right behind it at $414.59.
It's just completely trapped in a battleground of competing timeframes.
But look, technical charts only track human psychology, right? They just show us that traders are excited or panicked on any given day. To see if that excitement is actually justified, we really have to look under the hood and open Tesla's books.
And when you do, you see a completely different company than the one the stock charts imply. Yeah, the fundamentals are painting a very sobering picture of a legacy business in steep decline. I mean, let's look at fiscal year 2025. Tesla's revenue marked its first ever annual decline. It dropped 3% down to $94.8 billion.
Which is a psychological earthquake for a stock that has always been priced for infinite, uninterrupted growth.
Always.
Ah.
But it gets so much worse when you look at the profitability. Fourth quarter net income plunged 61%.
Ouch.
Yeah, let me put that in perspective for you. A 61% drop in net income for a blue-chip tech stock usually triggers a mass exodus of institutional capital. It's like watching a star athlete who suddenly starts missing all their shots. You have to ask, are they injured, or are they just trying to change the sport they play entirely?
That is a perfect analogy, actually, because the market expects hypergrowth, and instead it's getting severe contraction. But the company's defense is that they're intentionally pivoting.
Right.
They're shifting away from being a pure automotive manufacturer, just stamping metal and selling cars and transitioning into a high-risk AI and robotics company.
But changing your entire corporate identity is incredibly expensive. You can't just pause a global car manufacturing operation, take a 61% hit to your net income, and casually decide to build humanoid robots.
Yeah.
Not unless you have an absolute war chest to fund it.
Which brings us to the balance sheet. This is the one unassailable strength in their financial profile. It is an absolute fortress.
Really? Even with the drop?
Yes. Despite the income plunge, they're sitting on $137.8 billion in total assets. More importantly, they ended 2025 with $44.1 billion in total cash and equivalents.
It's compared to what in debt, though?
Only $14.7 billion in total debt.
Wow. That cash-to-debt ratio is just staggering.
Yeah.
They essentially have 3 times more cash on hand than their total debt load.
Exactly.
That gives them the runway to fund this massive AI transition without being squeezed by high interest rates or, impatient creditors.
Yeah.
And even with the falling vehicle deliveries, their automotive gross margin is clinging to 17.9%, which is still respectable in a very brutal, capital-intensive manufacturing sector.
Yeah, the traditional auto business might be decaying, but it's still throwing off enough cash to keep the lights on while they build the robots. However, the real savior on the income statement isn't the cars at all.
No.
No, it's the energy segment.
Oh, right. I was digging into those numbers in the sources. The energy storage deployments are exploding right now. Segment revenue grew a massive 27% year over year, hitting $12.7 billion. We're talking about their megapacks and commercial grid energy storage.
It is their most profitable division. The Megapack business operates on a completely different economic cycle than consumer vehicles. It's utility-scale infrastructure.
Sure.
When a regional power grid needs stabilization, they buy these massive, high-margin battery installations. That 27% growth proves they aren't just making conceptual promises about non-auto revenue. They are actively delivering it in the commercial sector.
But let's be real. Nobody is assigning a $400 share price to a company just because it makes good industrial batteries. The valuation is entirely anchored to this wild transition from cars to robotics.
Right.
Here's where it gets really interesting.
Yeah.
Because that pivot is violently dividing the market. Let's lay out the bear case first, because it's rooted in some very harsh, undeniable realities about the core business.
Yeah, the decay of the auto segment isn't just a quarterly blip, it is an entrenched trend. In 2025, overall vehicle deliveries fell 8.6%.
And they officially lost the global crown. BYD is now the world's largest EV maker by volume. The competition didn't just catch up. They overtook them, leveraging massive scale and price undercutting in the Asian markets.
Meanwhile, the future of their auto business, the full self-driving technology, is facing intense regulatory hurdles.
Right, the crashes.
Yeah, their camera-only approach, which relies on visual data rather than LiDAR radar systems, is under federal scrutiny after a series of crashes right in their own backyard in Austin.
And you also have a severe demand problem in key legacy markets. The sources highlight a 39% registration drop in Europe, and analysts have linked that decline directly to brand damage stemming from CEO Elon Musk's political visibility.
Which is a huge factor to consider.
Yeah, and we need to state strictly as an objective, reported metric. Regardless of where anyone sits on the political spectrum, when the CEO of a major consumer brand becomes a highly visible, polarizing figure, it creates friction with certain buyer demographics who have alternatives. A 39% drop in European registrations is the tangible financial cost of that friction.
Right. So the bears look at all of this, falling deliveries, a 61% profit plunge, intense regulatory scrutiny on self-driving and brand polarization, and they see a struggling car company making wild science fiction promises to distract investors from a failing core business.
So how do the bulls counter that? Because asking me to ignore an 8% drop in your main product line, ignore shrinking margins, and still pay $400 a share requires a massive leap of faith.
Well, if we connect this to the bigger picture, the bulls are asking you to look at a completely different paradigm. They're pricing in the physical AI revolution.
Physical AI.
Yeah, they argue that traditional software AI, chatbots, image generators, is just phase one. Phase two is AI applied to mass manufacturing and autonomous physical movement.
Meaning the AI actually interacts with the real world.
Exactly. And the catalysts for that are arriving right now. Unsupervised robotaxis have been actively testing in Austin since January 2026. This month, April 2026, the dedicated cybercab is scheduled to begin volume production.
But even if we assume the cybercab rolls off the line flawlessly this month, how does that economically dwarf the global auto market?
By fundamentally changing the math of transportation. Think about it. A traditional car sits parked 95% of its life just depreciating in a driveway. A robotaxi generates revenue 24 hours a day as a service. But the ultimate bull thesis rests on Optimus.
The humanoid robot. Wait, you're telling me analysts are modeling a $400 share price based on a humanoid robot that isn't even commercially available for sale yet?
They are looking at the stated target of producing 1 million Optimus units per year. If you successfully deploy 1 million humanoid robots capable of replacing physical labor in factories, warehouses, logistics, and eventually homes, the economic value of that labor replacement mathematically dwarfs the entire global automotive market.
That's wild to think about.
You're no longer selling a $40,000 car once. You're leasing a later replacement unit indefinitely. So the bulls view the car business simply as the early funding mechanism and the real-world training data for this incoming robotics empire. Energy storage is also growing deployments by 49% and is their most profitable segment, fueling this whole transition.
Okay, that is just a staggering disconnect in reality.
Yeah.
You either have a dying car company losing market share to China, or the birth of a labor replacement monopoly that will change human history.
Pretty much.
And when the narratives are this extreme, you can't just listen to the pitch. You have to follow the money. What are the insiders and the analysts actually doing with their capital? So what does this all mean for the retail trader? Are they walking into a trap?
They might be, because the analysts are deeply conflicted. If you look at the consensus ratings from Wall Street, you see a bizarrely massive spread. Price targets range from a low of $25 a share all the way up to $600 a share.
Wait, $25 to $600? A $25 target implies bankruptcy, or at least a complete collapse of the tech valuation premium. A $600 target implies the robotics play works perfectly and dominates the globe.
Yeah, the average consensus sits at a very murky hold. You have 13 analysts saying buy, 11 saying hold, and 6 saying sell. That complete lack of consensus is incredibly dangerous because it shows that traditional financial models are breaking down. Nobody truly knows how to accurately project the cash flows of a hypothetical robotaxi fleet or a humanoid robot that doesn't even have a consumer price tag yet.
When Wall Street is guessing, I look at what the people inside the building are doing. And the insiders are dumping stock right before this Q1 earnings report.
Yeah, the insider selling in the first quarter of 2026 is one of the most glaring red flags in our source data. On January 2nd, Director James Murdoch dumped approximately $26.7 million in shares.
Wow.
And then on March 6th, the chief financial officer, Vaibhav Taneja, sold about $899,000 worth.
Stop right there. The CFO selling almost $1 million in stock just weeks before an earnings report, where net income previously dropped 61%, is not exactly a screaming vote of confidence in the short-term outlook.
No, it's not. And the selling continued. Just a few weeks ago, on March 30th, Director Kathleen Wilson-Thompson sold roughly $9.27 million in stock.
Unbelievable.
While executives sell shares for various mundane personal reasons, taxes, buying real estate diversification, the sheer volume and timing of these dumps, directly preceding a high-stakes earnings call, signals a clear lack of confidence that the stock is going to bounce on Wednesday.
Which forces us to look at the actual valuation of what you're buying today. We touched on the price-to-earnings, or PE ratio, earlier. It's sitting at over 370.
Which is astronomical.
To put that in context for you listening, a normal, healthy car company usually trades at a PE of maybe 5 to 15. A hypergrowth software tech company might trade at 40 or 50.
Right.
370 means you are paying $370 today for every $1 of current earnings, based entirely on the blind faith that Optimus and Cybercab will print money in the future. It's like buying a neighborhood lemonade stand that makes $1 a day and paying $370 for it because the kid running it promises he's going to invent a teleportation machine next year.
That's exactly what it is. It demands absolute flawless execution from a company that just saw vehicle deliveries fall 8.6%. But the real danger metric for retail traders isn't just the PE ratio, it is the discounted cash flow analysis, or DCF.
Let's break that down, because a DCF isn't just an abstract Wall Street term. It is the ultimate financial reality check. It takes every single dollar a company is expected to make in the future and calculates what those dollars are worth today, accounting for inflation, interest rates, and operational risk.
It's essentially a financial time machine. When you run that DCF math on Tesla's actual, tangible, projected cash flows, discounting the sci-fi hype and focusing on the underlying math of the business, the model flags TSLA as significantly overvalued by up to 125%.
Overvalued by 125%, meaning the math says the stock shouldn't be trading at $400, it should be trading closer to, what, $175?
Roughly, yeah. And this is the exact trap that retail traders fall into. They see the technical breakout, the 3% jump today, the massive 90 million trading volume, and they suffer from severe fear of missing out.
FOMO is real.
It is. They buy in at $400, hoping to ride the momentum to $500, completely ignoring that the underlying DCF valuation says the stock is wildly overpriced.
The insiders are selling their shares to the retail traders who are buying the hype. If you are a retail trader buying in today at $400, you are taking on a massive amount of unpriced risk right before an earnings report that has a very high probability of missing expectations.
You're buying the top of a psychological wave, not the bottom of a value play.
So let's bring this all together and look at the timelines, because your risk depends entirely on your horizon. In the short term, meaning this Wednesday's April 22 earnings report in the next few weeks, this stock is a highly volatile powder keg.
Definitely.
If the earnings show that auto margins have decayed further or that Cybercab production is delayed again, that $385 support level is going to shatter. We could see the stock unwind rapidly toward $338.27.
But the reverse scenario is what keeps the shorts awake at night. If they surprise the market with better-than-expected energy segment revenues or provide definitive, undeniable proof of robotaxi scaling, the momentum could blow the lid off that pressure cooker.
It really could.
It could break the $409 resistance, blow past the $414 target, and trigger a massive short squeeze. The short term is essentially a coin flip heavily weighted by Wednesday's numbers.
But the long term, looking out to 2028 or 2030, is where you really have to pick a side in this ideological war. The bulls see a $2,000 plus per share valuation based entirely on this physical AI revolution. They see a world where Optimus and Robotaxis are printing high-margin revenue around the clock.
While the bears, looking at the exact same timeline, see a plunge back down to $200 or lower if the core auto business continues to bleed out to Chinese competitors and the AI promises are permanently throttled by regulators.
That's just a very real possibility.
It is. And this raises an important question, and it's really the core tension of this entire deep dive. If Tesla's entire future revenue model depends on unproven markets like humanoid robots and autonomous cabs, are we making a massive error by continuing to value them using the metrics of a struggling car company? Or are we being foolishly early in trying to price the world's first robotics empire before it actually exists?
That is the ultimate $400 question. We've laid out the technicals, the crashing auto financials, the AI pivot, and the massive insider selling. Now I want to know what you think. Is Tesla a textbook value trap destined to crash back to reality, or the most misunderstood tech play of the decade? Head down to the comments right now and tell us your thesis.
We can't wait to read them.
And while you're there, make sure to like the video and subscribe to our YouTube channel so you never miss a deep dive. Thank you for joining us today, and keep questioning the data.